Today we have Narayanan Muralidharan, co-founder at Morphosis Venture Capital. He's leading a 500 CR fund.
So been investing since 2017, 9 years now, across 3 different funds. We've come across situations where, you don't hear from founders for a very long time. And one fine day you get a message saying, we need to do a bridge in the next 15 days. We're running out of money. That doesn't really work.
How do you react to someone at a very early stage, not MVP ready, saying our valuation is 150 CR?
There's nothing wrong in aspiring to a certain number. Ambitious founders are the prerequisite to building a very strong company. Does that mean that we'll do a deal at that number? Probably not. We'll do our own homework. We'll come to a fair number that we feel is right for this company.
Top 5 reasons on why you say no to the founders.
The reasons where every investor might turn around and say, listen, I'm not going to get involved here, would be the founders are not full-time. If there's litigation, some sort of legal overhang, anything of that sort, most investors will step away. In terms of specific to ours, it could just be a little too early. It could just be a little too late for us. Valuations might not fit in our sort of model, in our sort of framework. There's a multitude of reasons, but I think these are the top ones.
Hello everyone. Today we have Narayanan Muralidharan. He's co-founder at Morphosis Venture Capital. He's leading a 500 CR fund and he has already invested 200 crore with different funds. So please welcome Narayanan.
Thanks so much, Usha, for having me.
Awesome. Narayanan, let's directly dive deep into what do you look into founders when they come for pitching and raising investments?
That's a very, very broad question, to be honest. And I think there's 100 different things that you end up looking at, and all of them have to kind of work out. But honestly, to just before everything, I think not every founder is a good fit for a particular investor, and not every investor is a good fit for a particular founder. So there's always a sort of a mix and a match, right? But I think this top few things, if I was to look at in a particular founder, right? I think it's the why of it all, right? What is the problem that you're solving? Why is this problem worth solving? And why are you the right team to solve this problem? I think if those three fit, then I guess we're good to go ahead and have a deeper conversation, right?
Understood. Yeah, that's really important. And would love to understand about your investment journey, how you started Morphosis, and even before that, when did you?
I'm an engineer, graduated from IIT Roorkee. First job off campus was in Flipkart. Great place to start your career. I think, a lot of ownership, a lot of freedom to do experimentations, learn on the job, and worked there for a few years before, I was kind of sure that I want to start a business. Didn't really have the best ideas at that point in time. So, decided to live vicariously by supporting founders with good ideas, and the best way to do that was through investing. So been investing since 2017. So it's been 9 years now, across 3 different funds, with Morphosis being the third. And I think there came a point towards the end of 23 where the question was, okay, I've always wanted to start a business. I seem to know what I'm doing when it comes to investing. So why can't a fund be the business that I start? So it was kind of marrying those two sort of aspirations and skill sets together. And that's how Morphosis came about. It's been, I think we got our structure in place December 23. We've been investing actively from the current fund since December of 24. So it's been about a year and 3 months since things have been active in life.
Oh, wow. Okay. And so what are the kind of companies that you are currently saying yes to?
So I think within Morphosis, we're focusing primarily on early stage investments in IP-led businesses, and within that, we kind of cut across hardware and software with the sort of first filtering lens being that, is there defensible IP in this business? And then, so if you look at our portfolio today, we've got something in cybersecurity, we had something in robotics, got something in new energy, something in digital infrastructure. But I think the common sort of thread across each of these companies is they have some sensible IP.
Okay, so they really need to have some innovation, is what I understand, and some IP registered, which is intellectual property registered, the idea.
Yeah, I mean, I think that's a fair way to look at it. Sometimes you don't really register an IP per se. It's sort of there's a whole spectrum, right? You've got patents, you've got trade secrets, you've got a whole bunch of other things that probably don't get registered, but they are unique to you, and it's going to take a lot of money and a lot of time for anybody to replicate what you're doing. So even if somebody comes to me and says, this is a trade secret, this is how we're protecting our trade secret, and nobody else can really do it, I'm willing to take a look at it.
Even if they are not from, let's say, robotics or deep tech.
Yeah, as long as there's IP associated to it, we're happy to sort of get into it, right? For example, the cybersecurity company that we're talking about, that's part of our portfolio, they have a patented code base, right? They've got two patents. It's not necessarily hardware, pretty much, right? It's a code base. It's applied. It's deployed in the cloud, but it works.
Understood. And what stage do they need to be in?
That's a good question, actually. So why we say early stage, I think the second filtration criteria that we have is it needs to have the research risk sort of taken care of. The way we look at the spectrum of investments is research, engineering, and commercialization. So we don't come in if you're still trying to prove the scientific principle behind what you're trying to achieve. But if you've proved that, you can pre-revenue, and that's fine. But if you've proved the scientific principle, you've got, the first version of the product ready. You're willing to sort of deploy it in field test environments, prove out that, the product works. I think at that point, we're happy to come in. In terms of a TRL lexicon, I would say a TRL 5-ish is our sweet spot. If it gets to commercialization, then it becomes a little too late for us. Early commercialization is fine, but if there's any significant commercialization, it becomes a little too late for us. If it's just an idea on paper and you're still trying to sort of iterate and prove the scientific principle behind it, then it's a little too early for us.
Understood. And what is the ticket size that right now you are investing in each of these startups?
So we start off with somewhere between 10 to 15 crores in the company. And we do have a significant sort of reserve ratio. So we do support our portfolio across multiple rounds with additional capital, but our entry point is at 10 to 15 crores per company.
Understood. Because this would really tell the founders when they can come to Morphosis for pitching and raising investments.
I think, honestly, every single company that we've invested in, we've had a relationship for more than a year and a half before we actually wrote the check. Most of them we've engaged with when they were too early for us, but kind of kept in touch with them, even helped them out on a few occasions with certain early sort of problems that they were trying to solve for. So we're happy to engage with companies when they're a little early as well, just to sort of have that conversation, see what they're doing, and then when the time is right, it becomes faster in terms of us actually pulling the trigger and writing a check.
Understood. And you said you literally had like 1 year of relationship with these founders. So what is the right way for founders to even get in touch with you to start that 1 year of relationship where they can, share all those updates, get you excited about what they are building?
So I think, thankfully we've got a fairly robust team in house, which sort of engages with founders, irrespective of how they come into the system, right? As long as it fits into the areas that we're looking at, we will engage. That said, if you know someone who knows us and who can sort of put you in touch, that's ideal. That's great. If not, even just a LinkedIn message or an email in my inbox is good enough.
Understood. And so there are a lot of founders that, you also have to say no to. If you have to quote top 5 reasons on why you say no to the founders,
Hmm.
would that be?
Sure. I think there are some that are just, non-negotiables that I'm sure every investor is going to look at and say, hey, listen, this is not going to work for us. And there are some that are probably specific to us, right? I guess the reasons where every investor might turn around and say, listen, I'm not going to get involved here would be the founders are not full-time. If you're not working full-time on the company, nobody's going to really be interested in backing you. If there's some sort of litigation, some sort of a legal overhang, some sort of dispute, either with a third party or with some of your vendors or whatever it is. If there's anything of that sort that's an overhang, then I think most investors will kind of step away. It, of course, includes criminal records, fraud, all of that stuff. If there's any history of that associated with the founders, then I think a lot of investors will stay away. In terms of specific to ours, there's a bunch of reasons it could happen, right? One, it could just be a little too early for us. The second could just be a little too late for us. Valuations might not fit in terms of our sort of model and our sort of framework. There's a multitude of reasons, right? But I think these are the top ones.
Understood. And so for a lot of such companies who are developing any, let's say, an innovative technology, right? So I understand it takes a lot of R&D and a lot of research, right? So when they are still researching about the product and doing all the developments and all these things, while the MVP is not ready, but the idea and let's say it's halfway through, they are not doing any revenue, right? How important is revenue or early traction for these kind of companies for you to invest?
Right. So I think revenue is not the only benchmark of traction, right? And I think especially as you rightly put it, a lot of these companies are sort of investing a lot of time and energy into R&D, and it takes time, it takes money, but there is qualitative progress that can be measured, right? And those qualitative sort of indicators of progress can be what the product roadmap was, how much evolution there's been, what's the enhancement in terms of capabilities. I mean, the simplest example, I guess, would be in the current day and age would be the newer and newer sort of state of the art LLM models that keep coming out, right? I mean, from say a GPT-3 to a GPT-4, there is an enhancement in capabilities. And can you have measurable metrics that show that there's an enhancement in capabilities? I think that goes a long way. It's also a question of founder vision. It's also a question of, okay, you're spending a bunch of money to get to this progress, but how efficient are you in sort of spending that money? How far are you actually able to stretch every single rupee that is available to you? Because end of the day, when it comes to early stage, I think most investors are investing in the potential of what the company can be. I think the traction or early traction is just a proxy for execution efficiency of the team. So you can measure execution efficiency from other metrics than just revenue. Of course, revenue has to be a focus as well, but at the right point in time, I would say.
Yeah. And so I hear this from a lot of investors when they say, we really look for that, the crazy amount of obsession that the founder needs to have for the product. So do you also look for that, or do you have a different criteria?
No, I think that's absolutely true, right? And I always tell this to the founders that we are speaking with, right? That when we have an IC, we need you to come in and have a conversation, because we can't speak as passionately and as insightfully about what you're building as they can, right? And if the founder is not obsessed and all consumed by the product that they're building and the fact that, hey, listen, this is going to change the world, if they don't believe it, then I mean, honestly, I don't think it's a place that we do want to be involved, right?
Yeah, exactly. So when I talk to a lot of founders, one thing that always appears is different valuation. How do they put the right valuation?
That's a good question, right? And that's always a case. I think investors want to invest at a particular number, which sort of optimizes their ownership. Founders, of course, want to optimize for dilution. I think there is always a middle ground to be found, as long as it's not just completely out of whack. I think a few things to note here, right? No investor is going to invest at the point of perfection, which basically is that a founder believes that if I have access to, let's say, X amount of money, I will hit A, B, C, D milestones in a year's time. Now, any investor looking at that is going to say, okay, that is the point of perfection. Everything has to go right for you to actually achieve those milestones in that timeline. What happens if something slips? What does that mean in terms of runway? What does that mean in terms of capital sufficiency? What does that mean in terms of, you know, being able to raise the next round? And is there going to be a down round? Is there going to be an extension? All of that stuff. And no investor really wants to get involved in that sort of a scenario. So they're never going to invest in the point of perfection. Founders, of course, are going to back their own ability to say, listen, I'm going to execute this. You may not believe it, but I am going to execute this, right? So there's always that push and pull. I think a good indicator to figure out what's happening is to look at what's happening in the market, right? Just look at current trends, because liquidity as well as the global sort of euphoria, or if you want to say reticence to invest, that does impact how valuations sort of move as well, right? I mean, back in, I would say, 2020, 2021, you would see people writing incredible checks at incredible valuations, and then today those same companies, probably with better metrics, are being valued at half what they used to be. So I think that it's important to know what's the market situation and kind of benchmark yourself to that. It's highly unlikely that a particular transaction is going to happen that's completely at a dissonance with what's happening in the market. So I think that's the best way to look at it.
Yep. How do you react to someone at the very early stage, not MVP ready? These founders saying our valuation is 150 CR.
Okay. There's nothing wrong in aspiring to a certain number. I mean, I think ambitious founders are the prerequisite to building a very, very strong company. Does that mean that we'll do a deal at that number? Probably not. We'll do our own homework. We'll come to a fair number that we feel is right for this company, in our view, and we make that proposition. If it works out, great. If it doesn't work out, but there are maybe there are other investors who have a different view of the risks involved, who have a different expectations of the returns that they are looking for, and their risk reward matrix sort of allows them to go to a higher number. So it's an open market. Take a look at what's happening.
Understood. I want to know what goes on behind, once, let's say I'm a founder and I'm coming to you, I have done the pitching. Now, what happens at the Morphosis venture or any other investors, and what do they start doing after that in order to move ahead to the next step?
Right. So I think there's two kind, and I'm talking about the funds that I've been associated with, and how we also kind of operate at Morphosis, right? And I just want to make sure that I clarify that different funds operate very, very differently, right? Because differences in strategy, there's differences in how they want to operate, all of that stuff. But I think there's two things to sort of evaluate when you're looking at investing in a particular company. One, of course, is the business itself. And the second is the softer aspect of it, which is the founders and your relationship with the founders. And there's an alignment in terms of ethos, there's an alignment in terms of vision for where the company needs to go to, and all of that stuff. Because honestly, it's a minimum 8 to 10 year relationship with the founders. And if you don't start on the right footing, then it is not really going to be useful for anybody, including the founders, right? So I think both of those tracks run in parallel. You've got the same team, of course, spending time into the founders, trying to build that rapport, trying to sort of get a feel for the relationship that's going to exist, as well as trying to sort of evaluate the business side of things, see whether it fits into your portfolio, all of that stuff. And once you've got a clear enough idea and you've got conviction on both aspects, you kind of go ahead and present it to your investment committee. These operate differently across different funds, but effectively, you need the investment committee to approve a particular transaction before you kind of go ahead and execute.
Understood. And so when these meets are happening, right, the first investment committee call, when these founders, let's say they are talking, what is some questions that you see a lot of founders don't ask, but they should?
As in, ask questions to the investors?
Yes.
Oh, I think there's a few questions that you should definitely ask as a founder, right? I think first and foremost is you should ask where you are in your investment life cycle. Funds have a limited life, right? Typically anywhere between 8 to 12 years. As a founder, you want to make sure that the exit expectations or the holding timelines of the fund are aligned with your sort of execution expectations and a little bit of buffer on top of that. So if there's a fund if it's a 10-year fund, and if it's in the first year of its deployment life, then you have a good 8-9 years before they have a lot of exit pressure, and they kind of translate that exit pressure downstream to you. Versus if it's a fund at the fag end of its deployment life, say probably in year 4 or year 5, that the next 3-4 years they're gonna require an exit, and does that fit into your sort of execution timelines in terms of being able to provide an exit in that sort of a time frame? So I think where a particular fund is in their fund life cycle is super critical to know. The second thing that I think a lot of founders don't ask is for an introductions to the existing portfolio, not for anything else than to get a really candid outlook of how the working relationship has been with a particular. I think those two questions should very much be top of mind for a founder.
Understood. And I think the kind of relationship the investor and founder has, I think they have a lot of hesitation in asking for these. But like, how open, are you usually investors are when they are asked about these questions, and even put me across to some of the investments that you have made, and I would like to talk to those founders.
I think most funds would be happy to do that.
Okay.
Because I mean, look, it's a small ecosystem, right? I don't connect somebody, they're going to find other routes to connect with that same founder and have a conversation. So that's not going to be a challenge whatsoever. And I think most funds are open to have to sort of making it.
Understood. And so when these founders are coming to you, what are the things that they need to be absolutely ready with, the numbers that they should be on top of?
Right. So I think one thing that we've seen, and I think that's normal, right, is an overestimation of what can be achieved with the capital that is in hand. Right. So I think, and this is something for typically for investors and founders to work together on and kind of arrive at something that makes sense, but kind of having a very clear view of what's the capital contingency in place, right? Let's say you're burning X amount, and you don't hit the numbers the milestones that you want to achieve, not even the numbers, you don't hit the milestones you want to achieve. What levers do you have to ensure that you continue kind of executing without burning through all your money? Right. I think so. That's one thing that founders should definitely have on the top of their minds. Secondly, the other thing that I see in terms of numbers that founders probably need to do a slightly better job in terms of being on top of is just the math. I've seen fairly seasoned entrepreneurs also come in and not be really very clear of what their numbers actually are. They'll quote you a certain number, you look at the MIS and there's a different number in there. How they're defining numbers internally, what's the right benchmark to kind of use. And I'll give you a very simple example, right? There was this one SaaS company that you were talking to maybe 3-4 years ago. They gave us a particular number that they're doing on a monthly basis in terms of ARR. And when we look at the MIS, it was a vastly different number. The difference, of course, was the fact that, hey, listen, we've got a verbal agreement from XYZ in terms of we're going to get a PO, but the PO is not coming. It's going to come in next month. While that's fine, you can always verify all of that information, have a conversation with the customer and all of that stuff. But having real clarity of, at what point do you include it in your MIS, and what is it that you are communicating verbally versus what your documentation or artifacts that you're actually sharing with the investors show, and there can't be too much of a gap there. Otherwise, the conversation doesn't kind of trails off into trying to verify all of that stuff as opposed to actually trying to understand what the business is. It's just a waste of everybody's time.
Yep. And other than that, like if we are talking about specific attribute, because we see some like really, I mean, that charisma in few founders. What are some those kind of behavioral or maybe personality wise some attributes that really gives you confidence that yes, we definitely should talk to this founder?
Sorry, I lost you for about 5 seconds in there. You were saying, just to sort of make sure I got the gist of the question, you were saying that what are typical personality traits that we look for?
Yes.
Right. So I think personality traits, I think you covered one part of it very, very early on, is the obsession in terms of building the business, right? How committed are you? How obsessed are you with the idea and the business that you're building? The second, it is collaborativeness. I think, and collaborativeness, working with a team, however you want to kind of put it. At least in personal experience, we've come across founders who just don't delegate well, and that does not scale, right? So having that sort of personality trait where you are a good delegator of responsibility over time, I think that's the second one that we look for. I think hustle, I mean, obsession, hustle, I guess it's two sides of the same coin, right? If you're obsessed with the problem that you're solving, if you're obsessed with the business, you're gonna really hustle and kind of make it happen. And the third and most important one is integrity, right? Integrity kind of not just in terms of, who you are and the right way of doing things, but also in terms of making sure that you communicate well with everybody on the table. We've got this saying in the organization that, good news travels fast, bad news should travel faster. And because things are going to go wrong as you're building an early company, things are going to slip, things are going to get missed. But having an open conversation about things that are not going right within the organization with your investors, with people around the table, ensures that there is people are working together to solve the issue and to kind of course correct. We've come across situations where people don't you don't hear from founders for a very long time, and then for one fine day you get a message saying, "Hey, listen, we need we need to do a bridge in the next 15 days. We're running out of money." That's really that bridge might have happened if the conversation was happening for the past 6 months that, hey, listen, XYZ items are not really tracking. We might need to solve this. That bridge might have happened. But if you get a call out of the blue saying, oh, over the past 6 months, so much stuff has gone wrong and we really need an extension of capital in the next 15 days or we're going out of business, that doesn't really work. So I think those few traits are quite critical.
Yep. When I look at it, these are kind of things when founders tell me they have raised. So actually, these are kind of things that they definitely have, otherwise they are just building that up. And also a lot of confidence into what they are doing, right? They are just coming and like top of their game, that they know every number, they know about competitors. They know the facts that as like even we would not know. So that is quite impressive, is what I feel.
Absolutely. I think founders know their business way better than we do. And they always will.
Yes. And so as an investor, what is your exit strategy when you are writing a check?
So I think we have a very clear outlook of how long we want to hold a particular company and what potential sort of gates exist beyond which there are potential investment exit avenues available to us at that point in time, and those kind of cover the whole spectrum, right? You've got IPOs, you've got strategic sales, you've got trade sales, you've got secondary sales, you've got so much across the board. And sometimes when things are not going well and you've got to find a home for the company, I think all of those options are always on the table. And I think at the time of making an investment for us, we've got a very clear idea of what gates need to be kind of traversed at which point certain options become viable or available.
Understood. And so I also come across founders who have got multiple offers from different investors, and now they have to make a decision on where they have to go. So how can they navigate better in these cases?
So I think the first couple of points that I had mentioned earlier, in terms of figuring out where that particular investor is in their investment life cycle, what's their holding price, and I think a few those sort of hygiene questions, of course, figuring out how they're associated with their other portfolio companies, what's the feedback. I think those couple of things, of course, matter. What also matters is maybe looking at which of these investors actually brings deeper pockets. They have a history of supporting companies through slightly harder times, so that which any company is going to have, right? Do they have they might have the intent, but do they also have the capital to support you? And if they're 80% deployed already, then they might have the intent to support you, but maybe not have the capital to do it at a point in time, right? So I think all of that, and then beyond that, I think a big consideration point here, of course, is how do these investors have any sort of capabilities that they bring to the table beyond capital that address my short-term goals as a founder, right? So for example, if and then we do a lot of IP first investments, so we end up investing in a lot of tech first founders, so to say, right? And if being self-aware as a founder or as a founding team and saying, okay, we've got great capabilities in technology, we've got great capabilities in terms of solutioning and delivery, but probably sales is a weak point. Does this founder come with relationships that could help us get our first $1 million in revenue or POC or anything of that sort, right? I think those considerations do become important at that point in time.
Understood. And for the companies that you have already invested, what are the kind of metrics that you track, maybe daily, weekly, or monthly?
Again, a good question, and there's no single answer to that. To be completely honest, because it's horses for courses, right? We get involved in companies that are pre-revenue, which are probably at that prototyping and testing in POC stage, right? So there's a lot of qualitative metrics that we end up tracking. I think what eventually ends up happening is at the time of investment, you've got an alignment of where the company needs to get to, and on a monthly, quarterly, annual basis in terms of where the company is going, and then you kind of have break those down into smaller milestones and timeline associated milestones, and you kind of just keep tracking that, and that could be across product, that could be across revenue, that could be across expense, right? How much are you spending in this point of time to kind of get to that, get to those metrics that you've spoken about. So it is very much a horses for courses conversation, and it really depends on where the company is at that particular point in time.
Okay. And when it comes to returns, right? What is the percentage return, or let's say 10x or 50x, that you usually look for?
So this is again very specific to a fund strategy, and honestly, somebody's coming in super early and they're not really looking at you're looking at it building a fairly wide portfolio or anything of that sort. They're looking for that 50 to 100x, right? Simply because 9 out of 10 investments are gonna fail. So that one investment that really does well is going to have to return that 50 to 100x for them to actually return a 4 to 5x at the fund level, at the aggregate portfolio level. So I think, so for somebody who's coming super, super early, and somebody who's coming in super, super early is also coming at a $5-6 million valuation. Honestly, if you want to go to a 50x, even with dilution over later rounds, if you get to a half a billion dollars in terms of value, they'll make their 50x. You don't really need to be $1 billion company to do that. But at the same time, those guys are going to come in with those sort of expectations, right? And then you kind of move upwards in terms of the risk reward matrix, where the risk sort of goes down and the reward also goes down, but you've got a lot more surety. So you've got later stage folks would probably be in it for a 3x or a 4x in 5 years, but there the margin of error is very low, right? They're going to come in at a point where everything's sorted, the business model sorted, the team's fairly robust, you've got all capabilities and all skill gaps sort of filled, the products completely proven in the market. At that point in time, they don't expect any company to fail. They're happy with the 3x or a 4x in 5 years. So it's really a question of where somebody comes in on that entire spectrum, from probably a idea stage investment to an IPO investment, and kind of looks for the kind of returns.
So for your current portfolios, has anyone reached IPO level and given you insane amount of returns?
I think the current Morphosis portfolio, of course, we started investing only a year ago, so it's too premature for any of those companies to be at an IPO sort of a stage. But from our previous funds, we've got a couple of candidates who are gearing up for an IPO, and maybe next year, because we're already sitting in March, so now next financial year, right? But gearing up for an IPO probably next financial year or the year after that. We've got a few candidates there. Yeah.
Understood. And can you talk about any company that, of course, you're comfortable talking about, where they were at a very early stage and then they came to you, and that's when finally this investment happened?
So we've got a company in our portfolio currently, which is called Trezix, which is an AI orchestration platform for global trade. Very senior founders, understand the business inside out, great product capabilities, great sales capabilities, to be honest. I think a very well-rounded, very well sort of qualified team to do what they're doing. And honestly, when we met them, it was super, super early, right? I think they were talking about an idea. They were talking about kind of going bottoms up, working with smaller sort of exporters, CHJs that exist in the market, and kind of providing them with a platform. And we engaged with them a while. We kind of kept giving them feedback that, this is where we see the market going. This is where we feel that your efforts are better placed. And they built for a good year and a half, kept having conversations with us, keeping us updated on the progress, as well as, asking questions in terms of, okay, what do you think about this? What do you think about that? We gave them our suggestions. They took some, decided not to take some, which is the right way to go about things. But eventually they got to a point where they built a really capable product, addressing the enterprise, kind of moving away from small businesses, moving away from CHAs, just because they realize that the appetite to pay, the realizations are not as high. Enterprise is a longer sale, but you got much larger contract sizes. You're solving a much more complex problem where you kind of end up being a value seller as opposed to a price based seller, which most small companies are price sensitive, don't necessarily want a lot of capabilities or features, but they want price to be foremost. So and got to the enterprise proposition, became a value based product, realization shot through the roof. And at that point, we said, okay, now we've always liked the team, like the area that they're building in, and fits into our sort of philosophy. They've gotten to a point where, the product's ready. It's been tested with a couple of enterprise customers, got pretty mature in terms of those GTM conversations with those customers, and of course, building a pipeline and all that stuff. So
Yeah.
good time for us to get involved.
Understood. And and so you have been into investment for so many years now. And I'm sure when there are good investments, there are also few that we regret. So without taking names, were there any investment that you regretted or maybe later on found something?
Right. So I think, and if I get your question correctly, there's this both sides of this coin, right? There are certain investments which you said no to, and then you realize maybe you should have done it at that point in time. And there are ones where you invest and then it really doesn't work out in the direction that you wanted to work out, right? And I'll give you an example of both, right? So I think one that I missed was Turtlemint. I had the opportunity to write a check to Turtlemint thrice, and each single time, it just felt too overvalued at that point in time. So we kind of didn't write the check. But every single time, you look back at it and said, okay, even writing a check at that valuation would have still made a lot of money. But hindsight is 2020, right? You really can't operate that way. One that we wrote a check and didn't really work out for us was Dunzo. So we were in Dunzo early on. Early days were quite good. They kind of the investment do quite well. But things go wrong at any particular point in time, and unfortunately, Dunzo didn't really work out for us at that point in time. But honestly, again, hindsight is 2020. Would we still make the same decisions today based on the information that we had available at that point in time? I would think so. I think what we've learned from all of this is, of course, things can go wrong at any particular point in time, and you can't really legislate for it. I think the one thing we've been really lucky with, touch wood, is that we've never had any integrity issues with founders, right? Any of that stuff, thankfully, in our portfolio hasn't really been an issue. I think there are enough cases out there where I'm sure, some in the media as well that you might have come across, but I think none of that regret kind of exists.
So that actually means that the kind of filter and your judgments have worked really well. So those things are.
You spend a lot of time with founders, right? I mean, you can't pretend to be something for such a long time.
So, and so whenever you're meeting such founders, let's say in a networking setup, and when they're reaching out to you, and a lot of founders ask me this, so that's why I'm asking directly to an investor. How do you like to be approached? Like, do they directly pitch you? Do they ask you about your day? How do you really connect? How do you?
Either works, to be honest, right? Either works.
Okay, but you're like more, I think, focused on what you're building. Like, let's talk about anything, but also like what you're.
True, but I mean, I think it sort of comes back to the same thing, right? That we spoke about a little earlier. That you have to be comfortable with the business and you have to be comfortable with the team. I think both things have to fit before you write a check. So whether you start the conversation by building that personal rapport, whether you start the conversation by telling me about the business that you're building, eventually it'll have to go in the other direction as well. If you started by building a personal rapport, you will also have to kind of educate me about what your business is, and vice versa, right? If you started by educating me about what your business is, we will still have to build a personal rapport. So either way you start works, it'll have to be both.
So, talking about how the investment climate is in the Indian ecosystem, do you see any shift from last 5 years to right now with AI in the scenario?
I think bunch of shifts, yes, right. And when you say last 5 years, 5 years ago was 2021, where it was utter madness. Right, there was just a lot of money available, zero interest rates, Fed was printing money, probably a few trillion dollars a year. There was a lot of pressure to deploy, and there was with that, and a lot of appetite to deploy, which meant that there was a lot of money available. I think since we kind of I don't think we're going to see a zero interest rate environment over the next 15, 20 years at the very least. That's just not happening. Which means that the cost of capital has gone up. People are deploying a lot more deliberately. So I think one massive change in the ecosystem is that there is very little room for mediocrity. You know, investors are being very deliberate in terms of what they're funding. They're taking their time to evaluate what they're funding. They're holding back in terms of reserves to make sure that their existing companies, the ones that are actually doing well, do have adequate financial support to achieve the outcomes that they are expected to achieve. So I think that's one sort of massive shift just culturally, right, in terms of how people are looking at stuff. Whips AI in the mix and more in terms of which direction, what's the flavor of the season, if that's the right question. Honestly, that changes every 6 months, right? I think a year ago it was AI, 6 months ago it was deep tech. Today we're talking about robotics. 6 months later we'll talk about something else. I think all of that, always, disruption's always going to be around. People are always going to there are cycles that'll happen, right? Where certain sectors are not looked at favorably, and then a couple of years down the road, those sectors are back in fashion. So I think those cycles always happen. I think businesses are not built for a 6 month sort of a trend. They're built for a good 10, 15, 20 years. So I think in that context, as long as it's a fundamentally good business, it'll always find investors. It's just going to be a question of how hard you have to work to find that investor, and at what value you get the money into the company. And trends will, of course, dictate a lot of that. But I think that's how I'm seeing the ecosystem right now.
Understood. And so when we talk about founders and when they are building, and a lot of founders just say, let's add AI and it would become more attractive to the investor. What do you think about that?
I think it's, the ecosystem is mature enough to understand the difference between AI for the sake of AI and how does AI actually added value to the product, right? I think most of the ecosystem is mature enough. Adding just a wrapper around it, saying that, hey, listen, I'm building this. I think people have also realized that, a lot of, unless you have deep integrations, unless you have some specific reason for involving AI into that product and it's solving a real business problem. I mean, at least what we're seeing in the ecosystem, just adding whatever the most recent buzzword is doesn't really go a long way anymore.
Yep, absolutely. So just, coming to the sectors that we were talking about, we spoke about you investing in robotics, deep tech, and of course, like AI as well. But are these sectors right now any more like, do you see other sectors being like really high potential, which are going to grow and you might look at them as well?
Right. So I think there's definitely a fundamental shift, right? India's consumption economy is what it is, right? It's a 1.4 billion people market. Consumption is always going to be at the forefront. I guess it's a question of whether the fundamentals of those business and the valuations of those business make sense or not. And again, like I said, back in 2018, 2015, 2016, consumer brands and consumption was a big story. Next 4 years, it was on the downtrend. Now it's back again. Right. So I think there are certain stories which will always remain, right? Consumption, of course, being one of them. I think longer term, the areas that we're super, super, super interested in, one is cybersecurity, right? We think there's a lot to be done. And when we say cybersecurity, we just don't mean on the software side, but we mean the sort of larger ecosystem. As we see more and more devices get intelligent, as we see more and more ingress points or access points or attack surface widening, if you want to call it that. There's a lot more to be done at the software level, at the hardware level. There's a lot of gating mechanisms that need to be built in place, a lot of fail safes, multi-layer security that needs to be built. So there's a lot to be done there. So that's one area that we're super interested in. The other area that we're kind of looking at quite aggressively is AI coming into the physical world. Not and that means intelligent devices, intelligent systems. Robotics kind of forms a part of it, but it's a subset. You've got so much more that you can do in the physical world with AI. The third one that we're looking at quite aggressively is new energy, and not just the sort of core value chain, but the first and second level derivatives of new energy as well, right? So if you're making components, if you're making some critical sort of aspects around it is another, and that includes material science, by the way, because a lot of work needs to go in the material side of things for any particular energy standard to become mainstream. Right. For example, we've got a hydrogen fuel cell company in our portfolio now, but hydrogen fuel cell is just one part of the ecosystem, right? You need innovation around the electrolyzers. You need to know innovation around hydrogen handling and storage, and both of those are very, very significant material science problems to solve. So yeah, so happy to look at all of that stuff as well.
Understood. And thank you so much for sharing that. Now I have rapid fire questions for you.
Okay.
What is the most boring business that you have funded, let's say, in the last 6 months?
Well, no business is boring, to be completely honest. I think that there's a lot of exciting stuff that's happening, even if you call a business boring. But so I wouldn't say anything in my portfolio is boring, so to say.
Okay, so the most exciting product that you have invested in?
The most exciting product that we've invested in is something called Data Motive. It's a cybersecurity company that's in our portfolio. Got a couple of patents, and it's a really proud moment for us as well, because it's a company that's been built out of India that's doing something that nobody in the world is even remotely close to. Right? They they protect and move your cloud infrastructure from across stacks within 10 minutes under a contractual guarantee. I think nobody comes even close to that. Right? They've been replacing competitors and customers across the world, and serious customers, right? Defense contractors, financial services, regulated entities at a premium price because of the capability that they bring to the table. So yeah, that's the most, I would say that's the most tech innovative product that we kind of got on board.
Yes, that actually sounds very exciting. And if you're looking at a pitch and you have like pitch deck and you have like 20 seconds, what is the first slide that you will look at?
This two. The first thing I'll see is what's the problem that's being solved, and second, the team that's solving the problem.
Sorry, second one is?
Team that's solving the problem.
Okay, so you look at two slides. One is the problem that they are solving, and another one who is solving it, the founder and the team, basically. Understood. And if you have to suggest one book or a resource for any aspiring investor and a founder, what would that be?
So there's a few, right? I think for a founder, I would say, and even investors for that matter, I think if it's one book, I would say Hard Thing About Hard Things. I think it's a book by Ben Horowitz. Yeah, that's a good book.
That's a good one. Understood. And so this one question that I had in mind. So what is the shortest time that you guys have taken to close a fund, like any investment?
Close an investment, right? Closing a fund is a whole different ballgame. It takes years, right? And anybody thinking about starting a fund, I'd say think again. But closing an investment, it takes time, and I think, and in today's day and age, I think, we keep telling our portfolio as well that if you're going out to market to raise capital, it's going to take 6 to 9 months from the first conversation that you have. You've got talking to multiple investors, but from the first conversation that you have, expect 6 to 9 months to money in the bank and plan for it is our recommendation to our portfolio. And that kind of goes back to where the ecosystem is today, right? It's just people have become a lot more deliberate. People have become a lot more discerning. They're taking a lot longer to write those checks. And I think in our case, I think Average timeline is about 3 months from the time we have the first conversation to the point that we're able to wire money. 3 months, a little bit here and there. That's the average.
Understood. Any final advice to the founders who are currently raising?
Like I said, plan for at least 6 to 9 months for money in the bank. And instead of over optimizing for dilution at any given point in time, the question really is this the right investor for my journey? And if it's the right investor, then a few percentage points of dilution here or there really doesn't make a difference.
Understood. And thank you so much for sharing that. Are there any more thoughts or anything that you would like us to talk about?
No, absolutely not. I think this was a very engaging conversation. Thank you so much for sort of setting this up. But nothing else. Yeah.
Absolutely. So thank you so much for your time. And I think I honestly find so many insights that would be so much valuable for the founders who keep asking these questions. I think this is once and for all, like just like these are the answers to your questions so that we can go ahead and ask more advanced level questions. So thank you so much for your time.
No, absolutely. And I hope this helps.
Yes.